But in general, when we're talking about triple net, we mean that when you're the landlord and you buy the property, you go to your tenant, you set up direct deposit, and all you're doing is collecting a rent check every year or every month. Maybe you send them a property tax bill every year, but that's about it. And usually these are 15 to 20-year lease terms. So they make really nice assets for passive income streams. They're great for retirement purposes. These are typically very stable assets with very low risk profiles. So as a result, the cap rates become very compressed compared to the rest of the market.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Michael Salafia. Michael is the founder and managing partner of Stax Real Estate LLC, a platform for sale leasebacks of single-tenant net lease retail assets located in Miami Beach. And in just a minute, we're going to speak with Michael Salafia about the benefits of triple net sale leasebacks for both investors and tenants. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Michael Salafia. Welcome to CREPN Radio.
Good morning, Darren. Thanks for having me on the show.
Well, I'm delighted to have you, and I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. So again, I'm Michael Salafia. I'm the managing partner of Stax Real Estate. And at Stax Real Estate, we're a sale leaseback platform for single tenant net leased assets. That makes us a mixture between being a commercial real estate developer, private equity fund, and brokerage, kind of all in one. I've been in commercial real estate investment arena for about 5 years, cut my teeth and got started my career in Marcus and Millichap from the brokerage side. And that's how I started learning more advanced strategies and getting into commercial real estate investing for myself and structuring deals on my own. And, you know, my family's always had a background in commercial real estate and retail specifically, going back to my great grandfather. So I'm kind of fourth generation of owning and operating commercial retail properties.
Got it. So that's a pretty rich history with fourth generation real estate. So did your family?
That's a very abbreviated version. I actually started my career in the technology sector, in tech and doing tech startups. But with these commercial real estate deals, the cash flow is so incredible on day one that it just became so much more attractive to me than some of the venture capital projects I was working on. I ended up working as a consultant for a number of real estate investment trusts and other kind of finance companies in the industry. So I started, before I went down the path to become a broker, I started as a consultant for large funds and financial institutions investing. So it gave me a very diverse background.
So were you consulting from a tech side then, or were you consulting?
Tech and communication strategies.
Got it. Well, that's clearly exploded here in the last 15 years with what was it was the Jobs Act. I know that was kind of the big push for all the marketing with the ability to raise capital and stuff. Was that part of what you were a part of then, or I mean, is that kind of what?
Right. How do you craft a investment presentation to raise $2 billion to build a commercial real estate investment trust? Right. These
Got
are
it.
the kind of answers I'd be coming up with.
Got it. Got it. So, in your family real estate experience, primarily retail?
Retail and multifamily. Yeah. On
Okay.
the east side of Providence by Brown University. That
Okay.
was the area that we were focused on.
Okay. And then when you were with Marcus Millichap, were you was it multifamily or what was your focus there?
No, I was on the National Retail Property Group and the National Net Lease Property Group.
Okay.
So I focused on single tenant net leased assets. I'd be happy to explain what that is.
Yeah, no, that's exactly where I wanted to get to. Uh, so we've got your background here. So let's talk a little bit about the triple net lease. Um,
Right.
it's always, everybody recognizes the NNN. I found that triple net is not always, or I guess there's some interpretations that can vary. What is a triple net lease? In that, what are the three ends?
So when we think about a triple net lease, just from a broad stroke, we think about a lease that has no landlord responsibilities and all tenant responsibilities. That's what we're
Okay.
talking about. And I agree, there are interpretations where maybe something says triple net versus absolute triple net. And maybe there's an exception where the landlord might have to pay the property tax bill on their own, or maybe the maintenance for the landscaping is reimbursed by the tenant, but the landlord pays it up front. There's various ways to structure it. But in general, when we're talking about triple net, we mean that when you're the landlord and you buy the property, you go to your tenant, you set up direct deposit, and all you're doing is collecting a rent check every year or every month. Maybe you send them a property tax bill every year, but that's about it. And usually these are 15 to 20-year lease terms. So they make really nice assets for passive income streams. They're great for retirement purposes. These are typically very stable assets with very low risk profiles. So as a result, the cap rates become very compressed compared to the rest of the market.
Right, right. In the triple net, I just wanted to go back real quick on the. I mean, I like the way you kind of said blanket. It's like no expenses to the landlord. Tenant covers all that. The ones that have always been kind of like identified in my experience is the taxes, insurance, and then maintenance is kind of the one where I've gotten kind of a little bit of the fuzzy. And you kind of explain a little bit like maybe
Mm-hmm.
landscaping, or I've seen where like the roof is the responsibility of the landlord, so I guess what I wanted to just revisit there, i- the concept is no expenses, but the details are negotiable. Is that fair to say?
Actually, Darren, it's as you explained. You have it correct in your head. So net, 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 right? So as we're the landlord, right, and we're adding up our rental income versus our expenses, and we're saying, here's our income net of insurance, net of taxes, net of maintenance, and breaking it into those buckets.
Got it. So
So,
then,
so in this case, your rent becomes, as the landlord, right? You're looking for what's my net operating income for the property I just invested in. Well, if it's an absolute triple net lease, your rent payment is equivalent to your NOI. Your annual
right,
rent payment equals your NOI.
well, exactly, and that's where I was trying to get to is the calculation then is it may look like a smaller number, but you have no expenses to reduce that number by. Uh,
Exactly,
so
exactly. And you don't really need a property management company,
right.
unless maybe you have 100 triple net lease properties and you want someone to administrate the leases and do that kind of work.
Got it. And as far as the cap rates, I mean, does a triple net change the valuation? I mean, again, we're talking NOI. NOI is NOI.
Absolutely.
Okay.
It will change the valuation because again, you're having the tenant pay for costs and you're having the tenant basically be your property manager. So you end up paying for that in the cap rate as compared to say a modified gross lease or a gross lease, which you might see in an office building, right? If we have an office building with many different small offices in it, it might make sense for us to just be office building operators. And that's our job. And we're going to pay the electricity bill, make sure everybody's office is set up. Now we're going to charge them a higher rent because we're doing everything for them. Right. And it goes in the exact opposite way. Whereas I go to, say, Chase Bank and I say, okay, Chase, I'm going to lease you this one building. You're in charge of everything. Just give me a rent payment every month. And I don't have to go and do the hedges the way they want them. They do that.
Right. Right. Well, and I guess what I was trying to understand though, so if the market cap rate for a particular asset class, uh, two similar properties, one's triple net versus one's, uh, you know, you're more involved and it's the owner managers are doing all of the maintenance, paying taxes and insurance. The NOI on those two, would they not be comparable? I mean, because if you have because I guess what I'm trying to understand here is, would one expect a higher NOI in one way versus the other? Does that make sense?
The yeah. So effectively, no, it should come out pretty similar.
Okay, that's I was just trying to see if there was
Yeah,
anything.
it wouldn't necessarily be a big difference. That becomes a very business specific decision. It's going to come down to the asset. I wouldn't say there's necessarily a global rule there. Um, but in general, it should be if you had the exact same properties with the exact same management, and all you're changing is the lease structure, the math should remain the same.
Got it. So that then brings me to, how do you identify an opportunity to have a triple net lease? And I would guess from a landlord perspective, what would be a or what are some of the criteria you would identify or recommend a landlord investor uh, be aware of when considering offering a triple net lease?
So they are owning a property and they're offering it to a tenant, or is their goal to buy a triple net lease property?
Let's take the first one in the you own it, and then also I want to talk about that if you're looking to acquire a property and there's a tenant uh, in it. But just if I own a property right now and I'm trying to lease it, uh, when give me some of the criteria that you would recommend that an investor landlord have in place or consider, whether it be like a caliber of tenant or term of lease or
Yes, and it really comes down to the type of the property, right? So
okay.
I focus on single tenant retail assets. Um, that very simply is most often a fast food restaurant, a drugstore like CVS and Walgreens, a gas station convenience store, um, a Dollar General, a standalone grocery store, Costco's, for example, are good single tenant assets. So I'm very focused on that. However, you can have a net lease on really any kind of property. Some of our offices are triple net lease structure.
but it's
So
but I guess the if I'm understanding right, the single tenant occupancy is key, is that not, for the to make it
the
work?
triple net structure works really well for the single tenant business model because you have one tenant that's very specialized in operating a specific property, and now you've just given them all the control. So let's talk about why do we love triple net leases in the gas station convenience store space, because that one makes a lot of sense when you think about it. Okay, So let's say, Darren, you own a gas station, right? And you own a convenience store, and you're looking for a new tenant. Maybe it's gotten a little run down, and you're like, this would make a really nice Shell station. If only I get Shell in here to put some fresh paint on it and put up that new sign I just saw down the street. I think it will pave the driveway. This place will look great. Okay. But you don't want to be responsible for all those pumps, right? You're literally pumping motor oil every day. Stuff could go wrong. And then you have a giant tank under the ground full of motor oil. You might want somebody managing that property who's experienced in this, who carries that kind of liability insurance, who handles those kind of insurance claims in their day-to-day business, who knows how to read the reports for all of this specialized equipment that you have on the property that's very environmentally sensitive and has a ton of liabilities associated to it, right? That's what it comes down to. Finding that tenant who really understands what they're doing. And it could be a fast food restaurant where you're like, these guys, they always have clean bathrooms, good landscaping, right? So you're looking at the bigger picture of the tenant. And that could be at a small or national level. At a national level, you can think of brands. I'll challenge you right now to think of some brands in your head where, you don't really want to go into that store. It's always a little kind of dirty. It's not your favorite store. And then there's other brands where it's a nice experience. You're comfortable with that brand. Say like Starbucks. Everybody likes the Starbucks for the most part. They have a good experience. Wawa, they have a great customer experience. So those kind of things are what we might look for.
No, I think that is appealing, at least from a landlord standpoint, to know that you've got a brand with some recognizability and presumably some capital to maintain and operate and pay the rent,
Right.
kind of thing.
And it could be a large brand with a franchisee. So as a landlord, you should go to the franchisee's other locations and see how clean they are. How well are they maintaining the property? What does it look like on the outside? You can tell a lot just from looking at the property and maybe walking through the store.
Right. So you mentioned the kind of the national brands and then kind of even the franchisees. Do you find that for Triple Net, the uh, the brands and the franchises are kind of the target, or most often kind of the opportunity there, or do you find that there's a lot of the local, lesser known brands that can be a good fit for this?
I come from the national space, so the national brands are really all I know. I will say, especially living here in Miami Beach, there are some fantastic triple net lease opportunities in the hospitality space. I mean, I've seen even some nice trendy restaurants buy their retail condo and say, hey, we have 3 years of sales history, so why don't we do a sale leaseback and execute a 15-year triple net lease for a restaurant, right? And I can tell you, I go to that restaurant, it's great, they run a great business, I would buy that deal. It's not going to be as good of credit as buying a CVS store, but it's a good bet if you're interested in that kind of property type. So it really all depends.
Well, I was gonna say, I think the thing I've learned a little bit about uh, commercial, especially the retail, the value of the property is dictated a lot by the tenant. I mean, the caliber of the tenant. Am I saying that
Correct.
right?
Correct. And we'd measure that by the credit worthiness of the tenant, which is quite frankly a measurement of risk. You're measuring how much risk you have of that tenant failing to make your rent payment.
Right, right. So let's take the other direction we mentioned earlier. You're in the market, you're looking for a property, and you have a property you like that's it's leased. It's currently got a triple net lease. What are some things that you would look at when underwriting that property and the tenant to determine whether or not there's what the upside is and or the opportunity is?
Right. So, for example, we have a restaurant right now where it's near Philadelphia. Um, he had to kick out the tenant. They weren't paying the rent. And it was a national quick service restaurant operator, like fast food. So now we have this vacant fast food restaurant. So what we look at for redeveloping the property are a couple things. We're going to look at the other tenants that operate within that area. Say they have a location within 100 miles within the same state. So we know these tenants are active in this area. And then from there, we're going to look at market saturation and see what the competition is, where the closest location is for each one of these tenants. We run through this process called a void analysis, where we look for where the gap is in the market. What is the void that we can fill, and who are the potential tenants? And then our team of agents will go out and engage each one of those tenants one by one through a series of business development phone calls and meetings, with hopes of finding the right one that would take over that property. So we go based on the best and highest use and run through the likely suspects first.
And when you're looking for that's kind of the re-tenant thing. So when you find a property, would you the length of the lease that's left, would that factor into it, or how would you, or are you talking about just buying an empty property where you can now you're looking for a tenant?
Yeah, this was in this case, I'm describing an empty property where we're looking for a tenant. In the other case, you're talking about just acquiring a net leased property, buying a triple net property, which is, as you said, you would be very concerned with the amount of term remaining on the lease. Those are really the three big things that you're going to look at are what's my cap rate? I mean, besides price, obviously, what's my cap rate?
Right.
What's the credit of this tenant, and how many years are left on the lease? Those are the three biggest levers that impact the market value of the triple net property.
Got it. And as far as the lease terms, we've established the triple net aspect of it, but as far as the length, you mentioned anywhere from 10 to 15 years. Are there
Yes.
any kind of standard increases over that time, or is that all kind of
There's
negotiable?
what's typical. It's all negotiable. There's no standard practice, but what you typically see is 10% every 5 years or 2% per year. You really want to structure these leases so they keep up with inflation. So anything below what's effectively a 2% annual rent increase could get dangerous for the owner. We've seen this before. I saw a Burger King where the lease was signed. It was here in Miami, and the lease was signed in the 1980s or late 70s or something. And the rent was so low and they had such a strong lease that it was artificially decreasing the value of the property. So the most we could underwrite the property for based on the lease was like maybe $800,000. Meanwhile, this property, the real estate's worth like $5 million based on the average price per acre, according to the comps. So you have a big discrepancy in the two appraisal methods.
Yeah, no, that
You can
would
run into that. Yeah.
well, I was gonna say if you have a long lease and it's written on some historical terms when maybe real estate wasn't doing as well, that could be a bummer if you're trying
And
to sell. Yeah.
here's something very interesting about the valuation of these assets, that I don't think most people fundamentally understand. So when I was first getting into this, I said, okay, so you're telling me I have a 15-year lease, and the value of the asset, its maximum value is when the lease hits its maximum term. So therefore, the value of the asset should decline year over year. However, you also have a rent increase, which could technically be offsetting it. But overall, when you have 15 years versus 10 years term remaining on a lease, it's going to impact the cap rate. The cap rate's always going to be higher for the 10-year deal versus the 15-year deal, assuming all other conditions are the same. So
Got it.
I thought, well, then there must be a linear decrease in valuation every time um, you lose a year of lease term. That is not the case based on my independent research. So I took all the comps data that I did 1 year and compared it, and it's not linear, it's a waterfall. You have cliffs, you have value cliffs that you go off. So the biggest one is after year 10, huge value cliff. The difference in your valuation between having 14 years or 15 years left, 13 years left, very little. The difference between having 13 years versus 9 years, huge. 10 years versus 9 years, huge value cliff. It just works that way. I mean, that's what I've seen based on studying the comps, and I believe it's, primarily consumer psychology at that point.
And is that just based on the length of the payout that's scheduled? I mean, that there's a potential to lose a tenant, or what's the?
Your thought process is accurate, and typically we are looking at the net present value, but I'm literally saying the difference between your valuation at year 10 versus year 9, it's not linear between 11, 10 to 9. There's a big cliff that happens between year 10 and year 9. It's just the market value goes down dramatically. These are all market conditions. And this
So
could be changed by market behavior changing, but this is just what I've noticed in my studies independently.
sure. So I guess here's something to ask you. So if we have an investor and they're looking to buy a property,
Mm-hmm.
typically, if I understand correctly, they would expect to pay more if the lease had 10 plus years in it, uh, in what you just said, versus
Yes.
if it was 9 or less, they
Right.
could perhaps get a better price. Um, and I guess my question is, and so is it as a investor, if you're looking to sell a property, is it sounds like if I'm understanding correctly, it would be best to first get it released with a longer term lease before you go to sell. Is that to get a higher price?
If your goal as the investor is to maximize the value of the property when you sell, then yes, you can go to a company like Stax that does these value add strategies, and we'll find a new tenant, we'll extend it to a long-term triple net lease and dramatically increase the value of the property. For example, you wouldn't come to Stax because we're leasing agents. You wouldn't say, "Oh, I have the shopping center, I want you to lease it out." That's not really what we do. But if you said, "I have a shopping center I want to sell," we need to get in all the leases and get everything organized and ready to sell. We'd say, "Okay, this is what we do."
Okay, so that's the next thing I wanted to ask you about is tell me about Stacks and what is Stacks?
Right. So at Stax, we work directly with tenants. We partner with kind of tenants and developers, and we bridge the gap using our sale leaseback platform to finance the opening of new stores. Basically, what that means is we're buying properties that are usually vacant, or maybe it has a tenant that I can move out with 30 days notice. Um, then I'm bringing in a new tenant, usually making some improvements to the property, some light construction work. We're re-imaging the property, putting up the new signage, oftentimes renovating the interiors, new bathrooms, new driveway, new landscaping, making it nice. We bring in the new tenant, we execute a long-term, call it 20-year triple net lease, and then we'll take that and we can sell it on the market to a private investor. We can sell it to a real estate investment trust or some kind of fund acquiring these assets. And basically, when we sell it, that's the money that we use to pay off the real estate and the capital expenditures, the CapEx that we put into the property.
Got it. Got it. So
That basically finances the cost of setting up the business for the tenant. So it's basically a franchisee, for example, coming in and getting to open up a new franchise, but they don't have to put $1 million down in order to get it done. We're financing everything.
so Stacks then basically facilitates that kind of the re-tenanting and getting the property leased. Am I understanding that right for the investor?
Yes, but more we're working with groups of tenants. So for example, we have Shell gas station operators, and we're working with them. We will find them their new site their new property that they want to take over. We'll arrange a real estate investor to basically fund the acquisition of the real estate. We'll arrange for another source of financing to cover any other costs they have for re-imaging the property. Let's say putting up fresh signs, new landscaping, renovating the interior. That's more what we do.
Got it. Got it.
So as a result, we have a lot of these brand new re-imaged net lease properties for sale, because every time we're done setting up a new store, usually we go and sell it. Or yeah.
Okay, I got you. So the goal then is more of the and for lack of a better word, flip the property. I don't want to compare these to, like a
Yeah, we're not
residential flip.
really flipping, because the value of getting that tenant to sign that lease for long term, that's extremely valuable, right?
Right. No,
You
but
had
I
an
mean, but
unstabilized property. Now we have a stabilized triple net asset.
right, but what you're, if I understand right, what you're doing is you're finding the property, you're finding the tenant, and then you're making it so it's a much more valuable property. And then
Right.
are you selling it then for the investor, or are you acquiring the property?
We have a private equity fund that we'll use to acquire the property, but
Gotcha.
our part of our strategy in our fund is to get in and out of the property quickly. So we're not
Got it.
flipping it per se, but if we can get our money in and out within 6 months, we're trying to turn over that money as many times as we can per year.
Sure. So like in a comparison, like a multifamily, the value add kind of thing, but that for, if you can do that in 36 or not 36, 6 months, that's a pretty quick turn to
Oh
get
yeah.
that. So, okay. So that's the appeal. I get it now. That makes a lot of sense to me. So let me ask you, so when, you know, I think one of the things that I recognize and I love about real estate is that it's the buyer's opportunity to recognize the opportunity that the seller doesn't, or the seller's ready to be done with. And
Hmm.
so if I'm understanding kind of your ability and your company's ability, it's to recognize that which is not recognized, and to, improve and make more appealing, and add value to the property. But I'm assuming also add value to the area. If you bring in if you take something that looks kind of tired and all of a sudden you make it all pretty, and now there's traffic and uh, more of a viable
Big time.
property, it
You should
spreads.
you should see what we're doing in rural communities with hospitals. I have a project right now where the hospital is completely undermanaged, and this is a proper regional hospital for a rural area. So the population within 3 miles is small, but this is servicing people within like an hour to a 90-minute drive, right? It's a big place. It needs work. It needs a new management team. Management team needs a budget to bring in like the proper equipment that they need to offer the new modern services and collect the healthcare billables that are just sitting there not being collected. So it's another strategy where we're setting up a sale leaseback, right, for this operator, and getting them some tenant improvement allowance in the process in order to get this rural hospital up to place. But when this one works, my point is we'll have a bigger impact. If we do 10 of these this year, I mean, that's a lot of communities that we impacted and gave proper medical care that were lacking it before.
Yeah. So let me ask you, I mean, what's interesting to me, and just kind of thinking, it almost feels like you guys are really touching on the operation side of things. Whereas a lot of times I feel like the conversation about real estate is the, more of the asset and the revenue it can generate, as opposed to the actual operations. Does that make sense?
It
Whereas it feels
does.
like,
And it
am
sets
I,
us apart at Stax. We're very focused on the mechanical operations behind the business and what's supporting that rent. And we dig in deep and we consult with these operators. We work very closely with them. We go through all of their books and records in detail to understand, what their business model is, where they're making money, where they're losing money, and we structure every deal in a sound way but it works because it's a single tenant net leased asset. It works because it's one tenant with one building at one site, and it's going to have one traffic count and one population count. So we can break it down on a store by store level, doing it that way.
Yeah, no, I think that's interesting. I mean, I hadn't really thought of it in as much, but I mean, really that how important the operations are, uh, and your ability to recognize and to, find either a better operator and or improve the operations of the current operator. I'm assuming more often than not you're uh, switching operators versus uh, consulting the current operator to improve their operations. Am I correct in that, or?
We're working with existing operators to expand into new locations.
Okay, that makes sense. But you're qualifying the operator first, and that they're a high level operator before offering
Correct.
them. Got it. Got
Correct.
it.
And then maybe we'll provide some guidance along the way, or maybe we'll learn some things, or
Got it.
both.
So tell me, who's an ideal prospect or a candidate to work with Stax?
Right now, we're looking for more operators in the medical space or gas station convenience store or quick service restaurants. So any fast food franchisee would be a great person for us to talk to. Excuse me, gas station convenience store operators would be great. Operators of urgent care facilities, or any kind of replicatable medical retail. We're very focused on essential retail properties.
Got it. And your territory of operation, are you limited to the Miami area, or how far and wide do you go?
Nope, through our brokerage of record network, we can transact in all 50 states. We have deals going from California to South Florida. I do most of my business in Florida. I have numerous brokers, agents, consultants, and partners that work for me. Not all of them are located in Florida. Some are in Chicago and Tennessee and other parts of the country. So we're pretty spread out and very well virtual connected with our home office here in Miami Beach.
Got it. Got it. Hey, Michael, if we could, I'd like to shift gears here for a second. As I mentioned to you before, by day I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an
Mhm.
option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, investors, the Fed, um, you know, local municipality laws, whatever, um, and identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Michael Salafia, what is the biggest risk?
As an investment manager, it's the fluctuations in interest rates are our biggest risk that we are dealing with at the moment. The changes have become very the changes of interest rates are somewhat predictable to a degree, and we get communication from the Fed. Our challenge is the market reaction or slow reaction, and kind of gauging how slow the reaction is going to be to these shifts. So getting sellers to understand that, you know, interest rates are not at 3.25, they're now at 7.25. So your 5 cap property that you think is worth a 5 cap is now worth an 8 cap, and getting them to swallow that pill. That's been the biggest challenge.
Yeah, no, that's certainly a challenge with if you're going to have to borrow to buy. Um,
So, and then let's talk about biggest risk in net lease investing in general. My biggest concern is what happens if the tenant doesn't pay rent, right? What do you actually do? I say, oh, I'm going to sue them. Okay. You ever sued somebody before? You know how that works. I'm going to do this. I'm going to do that. Well, at the end of the day, you have a tenant and then typically you have a mortgage and you're responsible for paying the mortgage. The tenant is responsible for paying you. You need to get this over here. I don't know. It'd be great if there was some kind of insurance for tenants' failure to pay that backed up mortgage payments. I'm sure there's lots of complicated tools for this, but gaining a better understanding and, thinking out loud that I don't have a deep understanding about this, given I've done 350 million in transactions this year, right?
yeah, no, you're not the first person I know. I've had insurance clients think that there was some sort of coverage for that, and on a typical property and casualty policy, there's not anything for a tenant not paying, unless there's been damage that was caused, and then perhaps you might have some sort of a trigger for coverage. But yeah, straight up, I have heard of some lease protection type stuff, but it's been more like in the residential uh,
Mm-hmm.
arena. Um, but it's interesting as you say that. I'm kind of curious why the concept wouldn't work on the commercial unless it's just a matter of the law of numbers. Um, there's probably a significantly lower risk with a residential tenant than there is on a commercial tenant, and maybe an opportunity to you know buffer or spread your risk with more versus the fewer kind of thing. So I don't know.
Right. And also for commercial investors, just our appetite. Why are we in commercial real estate? For me, I don't want to pay that insurance. I'll take the risk, right?
Right.
Overpaying the premium because if something does happen, that's why I'm a professional commercial real estate investor. I'm prepared for something like this to happen. I really don't need to go to the insurance company to go through that. What I would like the insurance company to do is cover me if there's damage from a hurricane or there's theft or vandalism, that kind of thing.
Right. And I think that, that is the traditional insurance model is physical damage to your investment. And I would say that what I heard you say is more often than not, the investors I would categorize in the newer investors and the more seasoned investors. And the newer investors tend to be a little surprised, whereas the seasoned investors just kind of go, well, that's part of the deal. Um, these things happen, and that's why you got to have some reserves, and you got to have, more than one property.
Think
Uh,
about it this way. You buy a $10 million property, 75% LTV. That means you only put down $2.5 million cash. Now you have a $10 million property. You got it at a 7.5 cap. Okay. So now you're on the hook for there should be $750,000 of rent coming in. You have to make your mortgage payment. Mortgage payment is going to be substantial. If that tenant fails to pay, that is a big number to cover. And you're someone who bought this $10 million asset with $2.5 million down. You're trying to, make your return on your 2.5 and cover your mortgage payment. That's where you can get into when you get leverage like that. You could get into a bad situation if you have a tenant that fails to pay rent.
yeah, no, I hear you loud and clear. Um, and it is kind of I think what separates you know, the lesser capitalized investor from the larger
Mm-hmm.
institutional level investors, just that ability to take the hit and or weather the vacancy. Um, there is I don't know, COVID and all this kind of commercial reset, especially like with office, um, and even some retail. There's been a little bit of a reset in various markets, or a reset that's about to happen based on the vacancies and when the notes come due, and be interesting to see what happens in the next couple of years.
Oh
But
yeah.
anyway, well, hey, Michael, where can listeners go if they'd like to learn more or connect with you?
Darren, the best thing to do would be to visit our website. We're also on all the social media channels. You can find our website at staxre.com. That's STAXRE.com. You can also just type in Stax Real Estate into Google, and you'll find us on LinkedIn, Twitter, Instagram, everywhere. We're always posting. We're on podcasts frequently. We release a lot of articles, and we're very, very active in the marketplace.
Awesome. Michael Salafia, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Darren, it's been an absolute pleasure. Thanks for having me on.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.